to be on the show. You've interviewed a lot of successful people and a lot of talent. And so thank you.
Awesome. So I'm going to tell you guys, you're going to hear, a lot of times we have people who are from the angle of the general partner, of the sponsor. And a few times we had people from the private equity side or from the syndication side. But it's very important to have that because you might want to choose that side. And I've been in both. So I know exactly what it is. And Tommy's going to tell us all about it. And it's very, very exciting. Thank you so much, Tommy, again. Here, I want to, before we start digging into your story and your, the exciting stuff, just tell us what you guys do, like a two-minute elevator pitch, what your business does there.
Sure. Yeah. So I very recently retired from my W-2 job to pursue real estate investing full-time. So I'm focused on syndicating value-add multifamily deals in the Southeast, so primarily Kentucky, Tennessee, Alabama. I live in the Nashville MSA, so those are my markets. And so I add value to general partnerships via raising capital, investor relations, finding deals, and boots on the ground. And so, yeah, I'm here today to talk to you about, how W-2 experience could translate to the real estate industry. We're in an interesting time of the workforce. And so any other things along the way that may add value to your listeners.
And tell me something beautiful. I'm looking forward. This is, it already sounds exciting. Tell me something. I looked at your profile on LinkedIn and it looked like you were in electrical engineering. And,
Yep.
It's interesting to me also because my son-in-law is now studying electrical engineering. Tell me something. Let's talk about that for a second, because it's somewhat related to real estate, obviously.
Yeah.
Talk about this for a little bit, about that career.
Sure. Yeah. So electrical engineer, as a kid, I was fascinated by the simple things. So the fact that you could flip a switch and it completely illuminates the room, right? You can see after flipping on a switch. So understanding what went into that, the infrastructure, the architecture, and then also just kind of voltage, current, power, fundamentals like that was kind of fascinating to me. And so I was very kind of gifted in math and sciences. And so that played into a lot of what was needed. And so I graduated from Georgia Tech with electrical engineer. Not really publicized much, but also data scientist specialization from Johns Hopkins University. So very, very math and science related, which I hope will help me in my underwriting.
He's a man of many talents. Soon we're going to find out they're going to put you're a pilot also, something like that. It's very, very cool. Love it. I love it. So tell me something. What happens to a guy who, and you called it a W-2 job, and you have some W-2 jobs that, you got to run away from, and some W-2 jobs are fantastic, and it sounds like you had a fantastic job. Why going away from that to what you do today, before we dig into what you do today?
Sure. I love that question. So the company I was working for was amazing. The people I was working for was amazing, right? So on the surface, yeah, the question is valid. Like, why leave that? And so for me, I was entrenched in getting to personal financial freedom, right? And so I find that you're talking about money was something I was interested in. Having very open conversations about that type of stuff was fulfilling to me, right? It fed my soul. And so whenever we talk about the W-2 side of things, I was in various capacities. I was product support, I was marketing, I was sales. And I would say the majority of my time was spent either customer facing or in sales in some capacity. And so, but I couldn't tie what I was doing to my financial freedom, right? If I'm looking at what I'm doing, working for an electrical distribution manufacturer, we're servicing every industry on the planet, right? From healthcare to data centers, everything you could think of, right? Because everyone needs the power to operate. And so the only way I could even think to line that up with financial freedom via real estate, or just financial freedom in general, it's like maybe day trading, like stock trading and stuff like that. Because I have an in, I know like what projects some customers are trying to build. I'm very in tune with the bidding process, and so I know who's wanting to build what before they actually build it. So that was the only angle I could see myself having as it pertains to financial freedom. And I was kind of living two lives because I didn't want to do that, right? I learned early on is like, if I'm doing anything in the stock markets, I'm not going to do much past index funds, probably. It's too many P&Ls to keep up with. It's too much trying to hedge values and get ahead of the curves and stuff like that. But real estate was, I mean, it was easier for me to understand. And so, yeah, it was trying to live two lives, and I was struggling with that.
You know something, for some people, you know what, I look at it, the challenge is to really understand the numbers, to get to know the numbers, to understand, and to read a pro forma, understand what's IRR. For you was probably more of a walk in the park comparing to other people because of your, everything else that you do. So you have to just learn what it is and bam, you know it, and no problem. But going back to the story behind it, okay? How did it happen and what inspired you to actually do that? Tell us a little bit, the fun stuff. How did it happen?
Sure. Yeah. And I guess I'll go a little bit further back, but we talked about my W-2 history, but I'll go back to just me growing up and just kind of, that'll
Go
give
ahead.
you like
Yeah.
the foundation of work
The
and
more, the
everything.
juicier, the better.
For sure. Yeah. So I grew up playing sports. I started at the age of 5, swimming competitively. So as a result, growing up, I was very accustomed to hard work at a very early age. And so the result was a work ethic where I knew the results that I was going to get out of something were directly proportional to the effort I was putting in. So it helps that I had a big brother that is a little bit more than a year older than me, and I wanted to be his peer. I wanted to be on par with him. So he was the white rabbit I was chasing. So that's a little bit as far as the background and my upbringing. I had amazing parents along the way, and they supported me, and they were great. My first exposure to real estate was actually in my college years. So I was working odd jobs for a summer. I worked for a contractor who serviced mobile homes. And so that's repairs, landscaping, making them rent ready. We service several houses in Middle Georgia. So Macon and Warner Robins, if you're familiar. So it's a lot of cutting grass and the summer heat in Georgia. If you're not familiar, it's hot. There's a
I
lot
am
of
familiar. I used to live in Memphis.
Oh, okay, you're there.
Don't tell me hot. Yeah, go ahead.
Yeah, and so there's a lot of cleaning units that are post eviction. So there's mountains of trash, there's used diapers, there's hypodermic needles, there's rotten everything in the fridge. As a result, I get into real estate and I'm not scared of anything that I see on the MLS at that point. I'm like, this doesn't compare to X that I saw, or this doesn't compare to that time that, this other thing I saw. So fast forward to 2011. I bought a house. It was my first house via short sale. It was a 4-bed, 2-bath. To keep it brief, it needed work. It needed, like, every square inch needed updating. There was a pool in the back that was just a black lagoon, and I saw nothing but like the finished product. I was like, this is going to be an amazing bachelor pad, and it's going to be great. So it was a slow live-in flip. I rented a room to a coworker. I had it paid off in 8 years, and I sold it in 2020. And so there's a bit of a funny story as to why we sold it. But my fiance, now wife, at the time, we sold some things just to make like rip off the Band-Aid for the final payment. It's just because I wanted to say, I don't have any debt. I have zero debt. That was going to be a major milestone for me. And so we paid off the house in October 2019. And before the end of November, my fiance said, I found the perfect house on Redfin or on Zillow. She's like, it's got this and this and this. It's perfect. We can have guests over. And I said, you couldn't let us be debt free for a month. We couldn't even go 30 days being debt free. And you just wanted to pile it back up again. So that's my fun story of how we got there. But we sold that house, liquidated it, and then we used the capital as down payments to 3 single family homes. So they were base hits. I bought them off the MLS. They were retail, but they cash flowed. And that was in 2020 and the start of 2021. So I found that I thoroughly enjoyed the business aspect of real estate. So managing the portfolio, creating the LLC to hold the properties, analyzing the projections versus the actuals, moving money around, etc. I got a kick out of it. So after these 3 units, I took a pause to kind of reflect on what I had done so far. And it's like, I could have used more capital to buy more single family homes. I could pay $200,000 a door for renting for $1,400. Those are base hits in my market. And then maybe rely on the compound effect to take hold and all that stuff. Or I could buy something, i.e. apartments, that's $75,000 per door, has the same amount of cash flow, the same amount of principal pay down, a reduced risk profile, et cetera. And since then, I've been focused on the multifamily ecosystem. Work and play there.
Tell me something. I love that story. Let's focus for a second, on the part of, let's first of all, just to clarify the story, okay? When was the point from this whole thing where you actually quit your job to do what you do today?
Sure. So I quit my job 11 days ago.
Wow.
So pretty recent.
All right. Sounds awesome.
The fun story behind that. I'm sorry, Yishai. The fun story behind that.
No, please shoot.
I put in my 100-day notice on my 35th birthday. So that's my fun story to say. I'm 35.
35. All right. Good age. Excellent age.
For sure.
Excellent age. Tell me something. Let's dwell a little bit into the strategies. Okay. You went, and this is interesting. Before we go into the whole nitty gritty, multifamily acquisition strategy, I want just to take it back to your story, because you started with a single family home, going to 3 single family homes, and then boom, shifting into multifamily. And you told us pretty much, but I just want to make the emphasis, and everybody who's watching or listening, to just sort of a pause. Sometimes in life you have to and I'm big with that. I'm not anti-single. Some people make a lot of money from single family homes and do it their whole life. And great, awesome. And it's for them. It's great. But I'm always preaching why commercial real estate much better than single family homes and stuff. And obviously multifamily falls into that criteria. Tell us a little bit what happened in your head, and let's go over it piece by piece with numbering, with processing, with psychology, with everything of why single family homes became multifamily.
For sure. Yeah. And I had the opportunity to go to a Dealmaker Live in Texas a couple weeks ago. That's where I met Brandon Turner, and I got a selfish selfie with him there. And it's funny, everyone else is on a similar journey as mine, right? They could have 100 single family homes. They could have 1,000 single family homes. They could have 1 single family home. But eventually people come to the same conclusion of multifamily is the best way to scale. You can scale your business, operate effectively, and then also you can scale the investment. So you're scaling both ends of the spectrum, and so the ability to grow is greatly accelerated.
Amazing. So once you got into multifamily, you said, okay, I have 3 single family homes. What the size? How many units you said I'm going to go after?
Yeah, that's been an evolution, I'll say. The more
about that.
Yeah, for sure. And I'll preface it with I'm a lifelong learner. So last year I read 60 books. This year I've already read 30. So I'm a large consumer and advocate of knowledge. And one of the tips I have on here at the end, I'm happy to share, is kind of learning how to learn. So kind of training your brain. I think that's worth investing some time in, but we'll talk about that later. And so I'm reading all these books in the single family real estate, right? I started out stocks and Rich Dad Poor Dad, and then I got a fire under my tush in real estate. And I was like, this is very evident to me that you can add value in real estate in a way that you can't do with any other asset class. And so I read all the books that you probably could on single family, and then I just hit a wall. And then I started reading about raising capital, multifamily millions, and I eventually got a hold of Joe Fairless's best ever book, which is like the master blueprint of all things syndicating apartment deals. And so, and then also the more I learned about it, the more I realized it's a team sport, right? So I don't have to do everything alone. I could do one part of it and add value to the deal. And so just that aspect of like not having to own everything from soup to nuts was very appealing to me. And that allowed me, it goes back to being able to scale, right? I could start slow, or I could start fast, right? I could start whatever speed I'm comfortable with and still grow if I'm getting 1% better every day.
But okay, great. But about the amount of units, meaning obviously, what was the first deal that you went after? How many
Sure.
units?
So I haven't been a co-GP on any multifamily deals today, but the ones I'm investing in as a limited partner, there's a 100+ unit in Kentucky right now. If
That's
I
amazing.
I would say before that, I had a very immature mindset. I was like, I need to start small. I need to look at an 8 unit, a 16 unit, and just get comfortable with it. But that was when I also had the mindset of that I needed to do everything myself.
Exactly.
So whenever you start realizing you can play a very dedicated role, a much needed role, and still participate in a deal, then I was like, why can't I operate in a $3 to $5 million deal? That's my first one, right? 50 units, 50 to 100 units. I shy away from the 150 plus because you start getting into corporate money. But there's not, why couldn't I start with a 55 unit if I'm partnering with an asset manager, if I'm partnering with a loan sponsor and I'm bringing some capital to the deal? It's like, why can't I do that? And my conclusion was that there's no reason you can't.
You know something? This is so interesting because you are, to me, you're a bit of a different animal, as we call, because you have the talent and the to get your hands dirty. You have the knowledge. You have the experience. Let's call it experience. That's the best word. Because when going back to your first story, you said that you started going into and you saw all the diapers and all these graphic things and whatever, and you said, I'm not scared. And then you went into the single family homes, which is a completely different type of deal where you have to do everything yourself pretty much. And you have to become a very handy type of a person, which is, by the way, for those who want to be hands-on, this is the way to go, obviously. For those who are not so handy, like this guy here, okay? The best way to go is multifamily, obviously. But for you, you could have done things yourself. What caused you to say and become humble and say, listen, I don't have to be the big honcho. I can be the guy who brings the capital. I can be the syndicator and actually make money. And I don't have to do all that stuff, even though I can, even though I'm capable of learning it, even though I'm capable of, like getting into the details and going to see what I have to do within the property. How was that?
Yeah, happy to talk through that. Real estate and syndication in general, like I found that my skill set that I developed in my W-2 job, right, could have translated to do the full spectrum of syndication, right? I could have managed the managers, been a good, okay asset manager. I worked in spreadsheets way too much in my last role. And so underwriting was probably a short putt for me. Investor relations probably best suited my marketing and sales experience, right? I feel like I could have done well in any arena. And the focus is where I needed the most help. But to answer your question of how did I, coming from a long line of, getting my hands dirty, so to speak, how did I come to the conclusion of I don't need to do that anymore? I learned that in the single family houses. So I got some bruises early on where I closed on 2 houses on the same day. And I was like, I read all these books. I'm going to be a landlord. It's going to be great. And I had to let like the inquiries bubble up over lunch and get to them in the evenings. And I'd just taken a new role at the time. And I was like, this isn't sustainable for me. So really early on, I hired a property manager and that alleviated a lot. Before that, I was making the units rent ready. And so I was like, I'm looking forward to working with my hands. I'm going to change out some fluorescent tube lighting with recessed lighting. It's going to be nice. I'll patch some drywall and then it'll be beautiful. But I'm still managing that same thing where I'm trying to perform this new role with excellence. And I'm probably working 50 to 60 hours a week is the norm. And so finding time after work is a challenge. Finding time on the weekends, it's like, all right, let's go to Home Depot, get the part. Oh crap, we got the wrong part. Oh crap, it's a pandemic. I can only get it online. So I ended up, it took me about a month and a half to do what should have been a simple make a unit rent ready with just some touch up and paint. And that's when I realized I'm working in my business. I'm not working on my business. And so going into multifamily syndication, I'm trying to be really, it's like tension. I'm trying to be really mindful of activities where it's like, is this a low dollar per hour item that I'm working on? Or am I working on whatever adds the most value to my business? And so I ask myself that all the time to maintain priority and focus on what I need to do to build my business.
Tell me something, strategy wise, this is everything you say makes so much sense. Strategy wise, going into multifamily, which we do right now, you're getting into a deal, requires to have investors, right? You have to be able to bring investors in. That's the beauty of syndication. At the same time, this is the challenge of syndication. Tell me something. How do you do that? How did you find the investor base? How did you create people to come around you? Are you still doing it? Or you're still creating it? Tell us a little bit about this learning process that you're going through, went through everything. This is very interesting.
For sure. Yeah. So I think on anyone's first deal, you're going to be leaning heavily on your friends and family, but they've got to be prepared for that type of discussion, right? It's one thing, for your mom to be like, "Hey, honey, I'll support you in anything that you do. I'm an accredited investor. But it's another thing for her to understand. Okay, mom, this is a 5-year holding period. These are your types of returns. This is and walking you through like a sample deal package. This is an example of a property. These are your ranges of returns. Here's your annualized. Here's your IRR. Here's your cash on cash, and then here's your total return on investment. So being deliberate and being prepared for those discussions is kind of what you need to do before you even have those discussions with your family. Once you do a rollout to your family, I highly suggest using it as a way to build your list. So just kind of like an introduction email that says, "Hey everyone, this is what I've been up to for the past 5 years. Oh, by the way, I built a business for myself. I stopped working full time, and I'm now syndicating real estate deals." And I usually just kind of pause there and I ask, do you want to keep up with what's going on in my life? And that's like their mechanism to subscribe. So that's kind of what I would say as far as the introduction and letting your family and friends know. Outside of your family and friends, I think the question is, how do you raise money? How do you find investors? That's like probably the more sexy question that a lot of people are drawn to, because they're like, yeah, I get it, friends and family, next. And so with that one, it really is just talking to everyone at your job, letting them know what you do. If I was smart, I would have started more as a focusing on capital raising while I was at my W-2 job. My customer avatar is a 35 to 65-year-old working professional. By then, if you're 35, you should have, with that dollar range for the minimum amount on most deals in your 401k, you can have a custodian transfer it over and still roll it into real estate. And so really it comes down to you want to be aggressively networking as much as possible. If you want to do it well, you can do it slower or fast, however you want, but letting everyone work with that what you're doing and what you're interested in, and that you're trying to establish financial freedom for yourself. I think that alone will generate curiosity. You can't shove it down anyone's throat as far as say, "Hey, I know how to make money. Give me your money. I'll make it work for you." That's not going to work, right? It's got to be a discussion. It's got to be a dialogue, and interests have to align. Outside of your job, there's like what I'll call the creative networking groups, right? You can go to car shows, horseback riding, right? There's high net worth activities if you want to get focused directly on that. But even like going to the gym, do things that you would do, but just be open and vocal about it.
Tell me something. These are great tips, by the way. Excellent tips. I love it. When you're going and you're becoming a syndicator, you're becoming a guy who's looking for deals. Before we get to the sponsors issue, which we're going to get, let's hold on with that for a second, because that's a whole topic of its own. In terms of your deal strategy, you have to sort of take a pen and paper and write down, okay, what am I going for? Retail, triple net lease, like what type of office buildings, hotels, multifamily, 200 plus, core plus, value add. What did you do? Meaning, what was your decision? What type of deals you're going after? What is your, here's what I'm going after. And you tell everybody about, find me those sponsors who have those deals. We're going to talk about sponsors, as I said, in a second. So what type of deals?
Sure. Yeah. So I'm focused on any value add opportunities for the B or C asset class, under 100 units. So I'll just name a few places, but anywhere between Louisville and Huntsville. So that's Louisville, Bowling Green, Clarksville, Nashville, Columbia, Huntsville are kind of the major tertiary markets and primary markets. There's also
why there?
That is all along the interstate that takes you from Alabama to Louisville, and those are they're either great primary markets or they're growing second tertiary markets.
So you decided these are the location I'm going to go for. I'm going to go for up to 100 units. I'm assuming anywhere between 20, 30 to 100, right? Am I in ballpark?
Yep.
And okay, great. And I'm going to go to a value add, BC class, beautiful, excellent, great. Now, you have to find sponsors that have those deals.
Yep.
So what are your criterias as per what type of sponsors you want to find and work with? Because you have to come to your investors and say, hey guys, here's my partner. Okay, who is it?
For sure. Yeah. And so I guess maybe it's a pro tip I could put out there, but the best way that I find people has really, or early on at least, has been, I went on a lot of the daily podcasters. So Joe Fairless does a daily podcast, and Whitney Sewell also does a daily podcast. And so
excellent
you can just, yeah, they have the daily podcast. And so with that, they have daily guests, right? They have high volume guests on there. So I would just, they're pretty short. So I would just go on there and listen. And then if I liked the message or I liked the skill set that they had, whether it's content creation or managing assets or finding deals off market, stuff like that, I would find out how I like them and then add them on LinkedIn, say thank you for your story. And then eventually I'd come across people that overlap with my market. So I know 2 operators in Kentucky. I know one very well-known one here in Murfreesboro, Tennessee, which is where I'm at. And through that and the local multifamily meetups, I've met some other sponsors as well, some other full stack syndicators. So I'll probably have about 3 total in Tennessee. And then there's one also that services Huntsville, but they're not local to Huntsville. So.
Awesome. And what are your criterias about sponsors? They have to be like this, like that, meaning what do you decide in terms of who you're going after?
For sure. I would like them to have some asset management experience. And maybe that's part of it, because I would say in terms of an asset manager, I do want multiple years of experience or multiple deals, right? I know one gentleman who has 2 to 3 years experience, which as asset manager, which we'll say is low, but he's got double-digit number of deals, right? So I would say that easily compensates for the little time spent as an asset manager. In terms of the I guess what I like to see, I'm getting to the point where I'm getting savvy on the underwriting and I can call BS on some people's numbers. And so we're getting to the point where it's like I'm scrutinizing their numbers and their pitch decks. I try to reverse engineer them with my syndicated deal analyzer and see if I can come close to their raise or their types of returns based on their expenses, et cetera. There was one that I met from a reputable resource where the numbers in the pitch deck just didn't make sense. We're set to connect here in a little bit, and that's going to be, you can believe that's going to be one of the things I ask about. But it seemed like an actual math error that made it to a pitch deck, and I was like, I don't know. But I'm also not in a position where I can claim that either compared to his experience. But
so I can add to that. First of all, I love what you say. I love what you say because I can add to that and say that I was sitting on both chairs, on the chair of the GP, on the sponsor, and the chair of the LP. And as the LP, when you check on the GP, the sponsor, you want to make sure that they know what they're doing and they have the right experience, they have the right track record, they know what they're doing, et cetera, et cetera. But having said all that, let's say you've done all that, you've done the due diligence on the sponsor, you know that they know what they're doing, meaning you have a pretty good picture of it. You've found out that they're not crazy and they're human beings and these are future good partners, et cetera. All these things that you look for in a sponsor. Then comes the deal. And exactly like you said, you look in the underwriting and you're saying, is it working? Is it not working? Does it make sense? Doesn't it make sense? And from my experience, and I'm throwing it in, meaning to sort of strengthen what you said, that when you come to that, you can't just rely on their underwriting. You have to make sure that you're obviously getting it from them. You don't have to do it from scratch, but you have to look at it as you're doing it from scratch and take all their numbers not for granted. And it sounds a little rough. It sounds a little like harsh for people who are just getting into it. Say, oh, so I want to be this guy's partner, I'm telling him, get me in, I'll get you money. And then I'm like sort of telling him, oh, you're wrong. You're not doing your job right and all that stuff. The answer is no. Don't be scared, because eventually, and I've been there, if you're doing the job right and you're looking at the underwriting, you're looking at the numbers and details, in the end of the day, they're going to thank you, because you might find things that they didn't. Maybe his analyst did not see something that you might see. So it's very, very important that you'll be able to come back and say, I found something. Tell me what you think about it. I'm not saying that you're wrong or right. I just want to make sure. And if you're wrong, it's all good. I just want to make sure that we are on the right track. That gives you a better position as a shotgun. Do you agree with that?
Absolutely.
Did you have a feeling when you spoke to your sponsor, meaning the potential sponsors, that kind of conversation? How did that go?
Sure. It's something I ran past a couple other people first. I was like, the example was in a 10-year hold, the IRR was higher than the AAR. And I was like, well, for that long of a hold, I would expect the AAR to be lower. And I vetted out with a couple people offline. But I'll be bringing it to the sponsor's attention later this week. And we'll see if we can get past it. My fear is, if I'm primarily a capital raiser and I'm leveraging other people's deals, I still have to know that the numbers make sense. I can't just be like, hey, I like the guy, and he's got a decent track rate. Let's go with him, because we're in an interesting time where you may come across some individuals that are just making deals for the acquisition fees. And that terrifies me. If I'm trying to bring other people's money to that type of deal, that's like what I want to avoid. It's like, I want it to be a good deal. I want us buying on a good basis. I want it, my strategy is to buy on discount because it's mismanaged and stuff like that. And so, I'll leave it there.
Love that thought. When you come to a GP/LP strategies, tell me how you like it. It doesn't have to be this deal, but how would you like to see the splits and the logic that you learned, meaning from all the books that you've read and all the people that you've spoken with, in terms of the logic of what type of fees you're willing to take, or what type of or what matters to you, what matters to you less, and all that stuff. We must have somewhat of a philosophy. Can you share that with us?
For sure. Yeah, and I guess fundamentally, I would say that there needs to be some interest alignment between the operators and the investors, right? So, and maybe I'm biased, but I don't see having an issue with acquisition fees and disposition fees and asset management fees, right? Because you're committed to driving, the close of acquiring the asset, or the close of disposing the asset, or refinance, or what have you. So I'm seeing a couple instances where some people are waiving that, and at least maybe from an investor's perspective, they're like, yay, it's less fees. But from my perspective, I'm like, what? They have like no incentive. There was a deal I watched yesterday where there were 0 acquisition fees and 0 disposition fees, and the only thing they were charging was asset management. And I wanted to like tap them on the shoulder after the meeting, like, how are you doing this? Like, how does this make sense? You just have 5 people on a webinar and they're all doing it for free. I don't know if it's somewhere else in the deal or what have you, but that's a red flag to me. Whenever someone's like, we're not charging any fees, it's like, that tells me you're not motivated. It's like, oh, but I'll leave that at that. As far as the fees go, in terms of like partnership structures and who gets what percentage, right? The dream would be if there was a deal finder, an asset manager, and a capital raiser, right? That would be 33%. I'm more or less down the middle for everyone, but what I would love for people to come to the deal with is the mindset that I'm going to contribute more than 33% to earn that 33%. So not just, I don't want to build a team that's doing the bare minimum. I want people that are problem solvers. I want a team that are willing to go further than is required to get the deal done and take care of the investors that are funding this. So
I love that. Tell me something. Now that we are getting into the close, I love your thoughts. I love your thought process. I love your motivation. It's great. Tell me something. How can people find you, whether they are sponsors or they are potential investors who want to consider working with you? How can they find you?
For sure. Yeah, there's going to be two great places to find me. One is on LinkedIn. It's Tommy Brant, Tommy, B as in boy, RANT as in Tommy. So Tommy Brant on LinkedIn. I've also got, I've started a platform, tbcapgroup.com. There's no vowels in group, so it's tbcapgrp.com. So feel free to sign up on the subscriber list if you want to keep in touch and get newsletters and the blog articles that are coming out. So,
and you guys that are listening to Tommy right now, look at the links above, below, wherever you're watching. And if you're in the podcast format, exactly. If you're on the podcast, you just point it up for the people who are listening to podcasts. You just made with their fingers going up. So that those who are listening to the podcast, obviously look at the text and find the links and click on them to find Tommy and to work with him and to find ways to do business with him. Tommy, your story is inspiring and I love it. It's great. And I wish you really all the best. And of course, we'll keep in touch and we'll see what can be done together. And you guys that are listening, thank you so much for listening to us today. And I'll see you guys in the next show. Thank you.